this video, and the one that follows, we take a look at the cost of capital and the calculation of the weighted average cost of capital. And cost of capital is important. It's the measure of the riskiness of a project and the required rate of return that's going to be needed in order to get investors to take those kind of risks. Today's session is based, and the video that follows as well, are based on Chapter 9 from our course textbook. And in this session, we're going to take a look at the first of the two major topics, the cost of capital components, the different elements of capital, debt, equity, and a variety of hybrid securities. And we'll take a look at the required rate of return to each of these individually. In the session that follows, we're going to take a look at how we put that together, the weighted average cost of capital, and how we bring together these individual ingredients into a soup that's made up of all of the different parts. And how do we establish the best or the most appropriate type of mixture that's going to make the best soup? The cost of capital components are considered to be long-term sources of financing. If you think about a balance sheet as having a top half and a bottom half, the top half is about the short-term sources of finance, the accounts payable, the deferred taxes, the payrolls that are due, and things like that. The current portion of the long-term debt, the things that are due within 1 year. And on the left-hand side of that top part of the balance sheet, we have the inventories and the accounts receivable and the cash, the short-term financing for the business. Our interest is in the bottom half of that balance sheet, the assets and the long-term sources of financing that are used to fund those long-term assets. There are three major types of long-term capital, or at least three categories that we're going to use today. The long-term debt, and by this I mean the portion of the long-term debt that's due after a year. We have things like preferred shares and convertible debt. Those are things that we describe as hybrids. And then we have the different versions of common equity, the voting shares that represent the ownership of the business. The capital components are the sources of funding that come from investors, and as I mentioned earlier, we ignore things like accounts payable, accruals, deferred taxes. The obligations that these represent are important because they also create stakeholders in our business. It's true that our suppliers have a stake in the business, but they don't have an ownership stake the same way that it is inferred by debt in the worst case scenario, and is definitely true in the case of common shares. So we do adjust for these things when we're calculating the cash flows of the project, but not when calculating the cost of capital. We also have to be aware of the effect of taxes. Certainly in North America, in most developed economies, income taxes on companies are a significant part of the overall cost of business. And so the effect of these of tax on the returns and the risk of these capital components is also going to be important. They can be incorporated in the capital budget and cash flows, in the measurement of free cash flow, or in the cost of capital. And in most cases, we incorporate the tax effects in the cost of capital. So our focus is on the after-tax cost. Now, not every component has got a tax effect. In particular, debt is affected by tax, especially in North America, in Canada, the United States. It's not true everywhere, and so we have to be aware of local tax codes and the way that tax is calculated. We describe costs as being average, historical, embedded costs, and also marginal. In fact, most projects we're interested in the marginal cost because we're planning for a project that's to come in the future. So we think about what is going to be the tax rate on the next dollar of income that we work. It's just like when you're working on for a company and you're earning a wage and you pay an average 20 or 25% tax at the end of each month over the whole year, but you say you'll do an extra shift, and you discover that that extra shift is taxed at a higher rate because it puts you into a higher tax bracket. So that would be the marginal rate, and not the average or historical rate. So cost of capital is used to make decisions about the future, about raising and investing new capital. So we should always focus on the marginal costs. The embedded cost or the average cost is important when we're doing things like looking at regulation of businesses and seeing what the average cost is going to be, but it's not part of our investment strategy. Cost of debt is the first type of capital that we're going to consider, and we've already looked at that when we considered the yield to maturity on bonds. That was a big part of the Chapter 6 material. If you wanted to figure out what the cost of debt is going to be, you'd need to know things like the default risk premium, as well as the risk-free rate and some of those other costs. And the good news is that you know how to calculate all of these things. You don't have to talk to an investment banker. The investment banker, if they were hired to do this, and they don't tend to do very much for free, would be able to tell you what the coupon rate would be if a new debt issue was going to be offered. But of course they're going to charge you for that information. The second method is the one that you know how to do, and that's to find the bond rating for your company. And once you've found the bond rating, if it's a AA or a triple B or a double B, whatever the rating is, you can compare the yield to maturity for a similarly risky company with a similar maturity and liquidity premium on the bond. And if that company pays a yield of 5.25%, and they're just like you, well, then that should also be the yield for your business. With the exception of banks, the predictability of that credit spread attached to a rating is actually pretty good. We can also find the yield on the company's debt, if it has any. Now, there's something wrong with this. It's using the historical information. So the yield on the company's debt is based on the past information, and so we're interested in marginal information, and things will change in the future. Right now, at this current point in time, we're looking at very low opportunity cost of capital or risk-free rate, because the government is providing an awful lot of capital at a very low rate. And so our historical numbers, the yield that we negotiated on last year's debt, will not be relevant to next year's debt. So method 1 and 2, very good. Method number 3, not so much. We also have to remember that interest is tax deductible, and that tax deduction can be significant if your company is paying 30 or 40% corporate tax. So we don't want to ignore that. We're interested in the after-tax cost of debt, and the after-tax cost of debt is simply the before-tax cost of debt, and that's the yield to maturity before tax, times 1 minus the corporate tax rate. In this situation, if we said that our yield on our debt was 11% and our tax rate is 40%, 40% times 0.6 would give us 6.6% is the after-tax cost of debt. Significantly cheaper than that 11% that we started off with before tax. For the yield, we would use the nominal and not the real rate, the published rate, not the yield, not the interest inflated rate. We also introduce a new term here called flotation cost. That's the cost of issuing a new security. So if I say that I'm going to raise $1 billion in new debt, for example, as TELUS did a week ago, they would have to hire investment banks to market the issue. They'd have to hire accountants and lawyers to create the documentation, and the cost of a $1 billion flotation would be in the millions, and a substantial amount of cost. If you're looking at a total cost of a few $100,000 on $1 million, that's also a substantial cost. But when companies do a lot of debt issues, the percentage flotation cost tends to be relatively small. The amount is significant, but the percentage is small. So we tend to ignore it, but we can include that calculation. We won't do that for this part of the course, though. Preferred shares, on the other hand, we do tend to use that flotation cost. And the calculation of the yield on a preferred share. Preferred shares, you'll remember, are stock that are issued as well as the common shares, and they have preference usually in terms of dividends. Their dividends tend to be fixed. They're paid on a regular basis. They're not skipped the way that common dividends can be, and they don't change. Preferred shares are often issued as a stopgap in order to provide enough capital to keep the company going until they either raise new debt financing or they go back and issue another common stock issue. More likely they're issued by growing firms, and usually they're sold to a small group of investors, like a group of insurance companies or investment banks. In this case, our calculation depends on a certain bit of information, the price at which the preferred share is currently selling. In this case, it's $116.95. The preferred stock dividend is posted at 10%. And that's 10% of the par value, not 10% of the price. The par value in this case is $100. So that would be the price at which the preferred shares will be redeemed when they reach the end of their life. And in this case, there's a flotation cost that's quite substantial. It's 5% of the total value of the preferred shares. So our calculation of yield in this case essentially says we're going to take the dividends that are going to be paid and we divide it by the price after accounting for flotation. And so in dollar terms, we had a 10% dividend on $100 par value. So 10% of $100, that's $10. And $116 after accounting for flotation, 116.95 times 0.95. And so that gives us the total yield is $10 effective yield on an asset that's valued at $111, or 9%. There are no fixed maturity dates, and the dividend per share is the annual posted preferred dividend. You'll see that in some cases preferred shares actually trade just like stocks do. In some cases they're issued privately to a small group of buyers, and they don't trade, or at least they don't trade on a public market. And here's an example of a company which does trade publicly. It's called Husky Energy. And I don't know if you know Husky Energy. They're a company that operates in Canada. They have a ticker symbol on the Toronto Stock Exchange, HSE.PR, or Preferred A Series. This series has actually been bought back by the company, and you'll see there's now a B and a C series. When Husky needs to raise money, they could do it by issuing more common shares, they could do it by issuing debt, or they can use preferred shares. In this case, it's hard for them to issue common shares because this company, while it's publicly traded, is controlled by one family. Li Ka-shing from Hong Kong essentially owns the majority control. And if he issues more shares, he's going to lose his voting control of the company. So instead of issuing more common shares, instead of issuing debt, which may not be easily available through the banks, when he needs additional money, he goes and issues preferred shares, which have no vote. And when the preferred shares have been paid back, he now has the only claim against the assets of the company. You'll see that this is priced on a daily basis, but unlike a lot of the stock charts, it's not quite such a spiky type of stock performance because it doesn't trade as regularly. In fact, it might go for several hours before any of the preferred shares are bought and sold because the type of investors who hold preferred shares tend to be institutional investors. So that's one good example of a preferred share. Unlike debt, the flotation costs tend to be significant, and so we include those in our calculations, and we use the net price, not the gross price, in order to calculate the yield. And preferred dividends aren't tax deductible, as are common shares are not deductible, or common dividends are not deductible, and so we don't make a tax adjustment. And like all of our measures, we're going to use the nominal rate and not the real or the post-inflation rate. Preferred shares in general are riskier than debt. And that's because if the company is in liquidation, the debt holders have the first claim against assets. If the company can't afford to pay all of its dividends, the first one to go is the common dividend, the second one to go is the preferred, and the interest is always paid unless the company has no other obligation, because to miss an interest payment would put the company into default. Companies like to pay their preferred dividends on time and according to their promises, because they're not allowed usually to pay a common dividend until not only the current preferred dividend has been paid, but all of the preferred dividends in the past that have been missed have been paid. So they want to pay those dividends. And of course, if they are not meeting the requirements of their past series of preferred shares, then they're not going to be able to issue new ones. Now, as well, under common stock, we have a couple of different variations that are worth noting. One of them is called classified or restricted stock. This stock has special provisions. For example, there may be limitations on voting or no voting rights at all. It's something that we actually see in Canada quite frequently, much less so in the United States, and it's always controversial. Essentially, we would, in this case, classify our shares as being the founder shares that have full voting rights and the investor shares which might have restricted voting rights. A great example of this was when Alibaba went to market. About 100 Alibaba employees and owners had the full Alibaba shares, and if you bought the shares that were listed on the New York Stock Exchange, they had very limited voting rights. Essentially what this means is that the people who started the company get to continue to make the decisions. Quite often the new shares are called something like Class A or Class B shares, and voting rights are restricted, but the dividend rights are still there. And when you think about it, many investors really don't care about voting. Often when I receive a voting circular from my investment bank and they say, "Would you like to vote?" I tend to ignore those notices, because with the number of shares that I have, my voting interest is very small compared to the other institutional investors. Here's an example of a company which has classified shares. Quite famously, Canadian Tire was started in Ontario by a family called the Billies family, and when they started, they grew their business by adding franchise partners in that smaller Ontario market. They went for a listing, they became a public company, and when they did, they guaranteed the Billies family and the original franchise partners that they would be the only ones with voting shares. So now you can buy shares in Canadian Tire, but you can't buy the original founder shares. In this case, CTC is the original founder shares. That's the orange line that's represented here. And you can see that the two shares generally trade alongside each other because only a few people can buy the shares. The trading history for CTC is a lot less active than the trading for CTCA, which are the full publicly traded shares with the non-voting rights. Sometimes there are shares that are issued afterwards. For example, Rogers Communications has a B share that doesn't have voting rights, and those shares are issued like a dividend to people who already have the A shares. There are, I think in total, about 200 companies in Canada that have some kind of restrictions, and some of these companies you'll recognize. I know ones that pop off the page when I look at them include companies like Onex Corporation. You might have heard of those guys in the last year because they bought WestJet. It's essentially a venture capital firm, and it's controlled very closely by one family. And in other words, you can buy shares in their company, but you can't participate in the voting decisions. Only the people who have the founder shares can vote. In this particular article that was written by a shareholders pension fund group, which is backed by public unions, they said this isn't fair because take a look at the voting power for some of these companies. In the case of Onex, one founder share has about 800 times more voting power than a public share. Some of the other companies you might recognize: Magna produces auto parts, one of the biggest auto parts companies in the world. Teck Resources, or Teck Caminco, is one of our biggest mining company, and again, a founding family has essentially the control of that company. Shaw Communications, Metro, and so on. So these companies are all companies that have used that type of a dual class system. Now, back to the main topic of common equity. It's important to understand that there are a couple of different ways of raising common equity. The one that we hear about, the one that's in the news quite often, is when a company does an IPO. A company only does an IPO once. They become a public company by selling their shares on the stock exchanges. It makes front page news if it's a big company like Airbnb. And or Beyond Meat was another good one last year. So they will go to the stock market for the first time. They will take their shares and they will sell them to a broader market. Usually they only sell about 15% of their total shares that have been issued. The founders and the original venture capital companies still own most of the shares, but by trading them, that creates a price and helps the people who are already owners to determine exactly what the value of their shares should be. It's hard to go back to the market a second time and ask the market for more money, because essentially that creates dilution, creates more dilution, and it means that the new investors can only be invited on board at a very small premium or even at a discount. And it makes the value of the existing shareholders' wealth or investment in that company a lot less important. It's called a seasoned equity offering, or an SEO. Sometimes it's referred to as a rights offer because the existing owners have the right of first refusal to buy the new shares when they're issued. Now, even more importantly, companies constantly reinvest in themselves by taking the profits that they earn during the year, and they make a decision. Am I going to give that to the shareholders as a dividend, or am I going to stick it back in the company? Well, by reinvesting the earnings in the company, they're making a decision for the shareholders, saying we're going to reinvest your money back in the company. And now that's not something that's so obvious, because we take dividends as being an extra bonus, when in fact the dividends were our money, and the company has just decided to give us a small part of the earnings while reinvesting the rest in the business. So there is a true cost for reinvested earnings. Since they can be reinvested or paid out as dividends, the investors, if they took the dividend, and if they took all of the dividend, they could invest in alternative securities and earn a return, possibly a higher rate of return than the one they're earning for the company. So there is a true opportunity cost for those reinvested earnings, and they should never be ignored. They're not free sources of capital. The opportunity cost, essentially, is that the shareholders could earn an alternative investment of equal risk by putting their money into another company. They could buy similar stocks and earn a return to that stock, or they the company could repurchase its own stock, pushing up the rate of return on that share. So RS, or return to the share. So the return to the share, or the return to equity, is the cost of reinvested earnings. It's our true cost of equity. And there's several ways to calculate this. In fact, we've already seen two of these three. The third one is less worthy of note. CAPM, the capital asset pricing model, is the one that we discussed in the risk and return videos, where we talked about the cost of equity, or our required rate of return to equity, is equal to a baseline risk-free rate. Whatever the government is willing to pay on government bonds, we could put our money into that and earn that without taking any extra risk. Then there's the risky side of the investment, and that comes from two sources: the firm-specific risk, so market risk minus the risk-free rate, or the industry-specific, the market premium that we earn, RM minus RF, and the idiosyncratic rate, that beta. And so that's the best measure. We'll come back to that one in just a second. We can also use something called the dividend growth model. Essentially, this is one that's going to work if we haven't got information about a risk-free rate or a market premium. We always have information about the company's own dividends, the growth in those companies' dividends, and the current share price. So that'll give us an idea of the actual realized yield. And that's an alternative measure. The third measure that we'll briefly touch on, mostly because our chapter covers that, is to use the bond yield that we earn from our publicly traded bonds plus a premium. Now, CAPM is probably one of the best supported and best understood concepts in finance. Essentially, it says that we know that risk-free rate is our baseline. And in this case, if 7% is our risk-free rate, very high compared to today's numbers, that's the rate that we can earn by putting our money into government bonds and not take any risk other than inflation. The market premium is the difference between the market rate of return on average in the long term, we'll come back to that one in just a couple of minutes, and the risk-free rate. So if our market premium was 13% and our risk-free rate was 7%, 13 minus 7 would give us 6% as our market premium. And the beta is the measure of the firm-specific or idiosyncratic risk. And in this case, we're a beta of 1.2. We're a little bit riskier than the average firm in our industry. So if we apply that using the CAPM model, we see that 7% risk-free rate plus 1.2 times the market premium gives us a required rate of return on our equity of 14.2%. Now, there's some issues with CAPM. And even here, I tend to disagree with our textbook in some respects, and most finance professors will not agree on this particular number. This says most analysts use a long-term government bond of 10 or 20 years. That requires regular trading in those bonds to set a price, and there are very few 20-year government bonds in circulation. And there are other factors that may of liquidity that may affect the pricing of those bonds. So in many cases, analysts will also use 5-year bonds. So anything between 5 and 20 years. And in particular, I would say, or personally, I would say that I would rather use a 5-year bond that's regularly traded. And that's especially true the way that markets are changing right now. So we can use a 5-year bond also as our measure of the risk-free rate. Again, our textbook says to use a 5 to 6.5% market premium. I would suggest that you consider using the Credit Suisse Global Investment Return Yearbook we talked about in earlier videos, and I will talk about in a couple of minutes, to get a more accurate measure of the market premium. And beta is a number that we can calculate ourselves, or we can get that from a number of different sources. Beta may be calculated many different ways. We see that the most commonly used calculation of beta is to compare the covariance of the firm's risk to the variance of the market for a period of 5 years with monthly sampling. Other sources like Bloomberg, our Bloomberg terminal, may use 26 weekly measurements. And so they'll end up with a beta which is more accurate in the short term, but may not be representative in the long term. So, and we can change that with the Bloomberg terminal. We can adjust those settings. So beta can be calculated several different ways. We need to be aware of that. And like any other type of regression, it's subject to forecasting risk. And so we may have a low R-squared value for some of the beta calculations that we do. Now, to step back to market risk, we can get information about the market and the market rate of return in the long term by taking a look at the historical patterns of return. From the Credit Suisse Yearbook, and this is published every year, we can see that in Canadian markets, going back to 1900 and over the last 115 years in this particular case, the investment of $1 in 1900 would eventually increase to be worth $573 today in nominal terms, in real terms. And the rate of growth that it would take to increase $1 times 1 plus a growth rate to the power of 115 would be X percent. And so that is actually the rate of increase in the value of capital. And you can see here they've also done the same thing for treasury bonds and treasury bills. Treasury bonds are the longer term instruments that we tend to use for our comparisons, and $1 invested in 1900 would increase to be worth $13.30 after 115 years. Those measurements are actually shown in the report. They say, here are the actual average real rates of return. And let's take the column on the right-hand side of the table, the whole time series, here from 1900 to 2016. The average rate of return in equities was 5.7%. So 1 plus 1.057 to the 116th power would turn $1 into $573 over that period. And we have a rate for bonds, and so you can see that if you're looking at your market premium, RM 5.7 minus RF 2.2 gives us about a 3.5% or 3.4 depending on rounding error. Gives us a market premium that is a lot less than what we were looking at or promised in the textbook. In fact, we can see here that for that time period, 3.4% represents the market premium of equities over bonds. Now, that's the CAPM model, and that's where we get our data: the risk-free rate, the market premium, and the beta. We can also calculate the rate of return to equity using an alternative method. That's the dividend growth model, the DCF model, our textbook calls it in this chapter. Sometimes we hear it referred to as Gordon's growth model. This is a good model to use when you don't have sufficient information otherwise. Like a project I was involved with in Pakistan, we were looking at a company that was a power project near Karachi called the Hub River Power Project. And in valuing that project, we could not find a suitable risk-free rate in Pakistan. There were some government bonds, or rather some bank bonds, that we could use as a proxy for a risk-free rate, but the margin of error on that was going to be quite high. We could also use the stock market information from the Karachi Stock Exchange to figure out what the market premium was, but we had two problems there. Number one, the number was all over the place. It really wasn't, it changed every few years, and so we weren't very satisfied that was a stable predictor. And secondly, our company was going to be so big that it was going to move the market itself when it entered the market, when they did their IPO, and it did eventually. And the third problem we had was that we couldn't calculate beta because with such a large company, there was no comparable company to use to estimate beta. And secondly, when the company did enter the market, its beta would always be close to 1 because it was a big part of the index. So CAPM wouldn't work for us. In that case, we could use a discounted cash flow approach. All we needed to know was the predicted dividend levels, and we did have that information. We knew what the price would be, or at least at issue we knew what the price would be. And we know what the growth rate was going to be. And so we could actually produce a reliable, or the best possible, measure of the cost of equity. In this example, you can see we have some information about the company. Its dividend last year was $4.19. Its dividend historically has grown at a rate of about 5%, so that's G is 5%. And the company's share price today, P0, is $50. So our calculation, using the extended formula here on the right, our historical dividend times 1 plus growth gives us the predicted dividend for this period, or D1. The share price today is given, and G is simply the value of growth. The two sources of value in the company: dividend yield and growth. So our calculation now, $4.19 times 1.05 divided by 50 gives us a yield of 8.8%. The growth rate was 5%. We add the yield and the growth, and that tells us that from these two sources of value, the required or the expected rate of return to equity in this case is 13.8%. A third method. Better say something about growth first. Where do we get our growth rate of 5%? Now, we can use the historical growth rate from the company's pattern of dividend payments in the past to predict the future. We can also obtain estimates from analysts, and I'll show you an example of that in just a minute. And in all of these cases, uncertainty about the future is going to suggest that there's going to be uncertainty in the estimate. The analysts that I mentioned earlier provide forecasts. For example, this is from the Financial Times, an estimate for tech resources. And we have a pattern of the earnings in the past. And so the earnings and the earnings per share from 210 through 210 and into the next few periods is historical and also predicted. And they say that this is the rate that we expect to see, a 21.46% growth in the short term, and in the longer term, a 22%. Now, the Financial Times has not calculated this themselves. What they've done is they've collected the brokers' reports from many different investment banks, and they've looked at the predictions in all of those reports, and the average forecast provided by the analysts are the numbers that are given here. So they call this the consensus earnings estimates. Or another version from the Toronto Globe and Mail, or rather just the Globe and Mail now, you can see they've given us information, and you can get this information today from many sources, including the Globe. The earnings per share historically, and then the predicted. And you can see down here that they have 5, 6, 5, 12, 6. They've got a number of analysts who've provided predictions. And so here we've got information, the estimated or predicted numbers, 112, 119. We can figure out what the growth rate is based on those predicted numbers, and that becomes the value that we can use for G. An alternative way of doing that is something called the sustainable growth or the earnings retention model. And so if the company has a rate of return of 15%, that's the rate of return on equity, and they retain part of that, only part of it, say 35%, they pay out 65%, so 1 minus 0.65 is what we call the plowback, or 35%. And so to calculate the expected growth for this, we would take the retention rate times the ROE, in this case 1 minus 0.65 times the 15% rate of return on equity, and that suggests that G is going to be about 5.25%. So that's an alternative approach, the sustainable or self-funded growth rate. We can actually do calculations for this if we expect that growth is going to be 5%, 5%, then 12%, then 15%, or some variation of those changes. The calculations get a little bit complicated. There are several methods. Aswath Damodaran has a website at New York University where he publishes several of those methods, including things like a 2-stage and a 3-stage model or a half-life model. Those methods those calculations are complicated, and we won't be covering them in our session today. Now, the third method, we have CAPM, we have the dividend growth model, and the next method is the bond yield plus risk premium model. It sounds quite arbitrary to me. I think it is quite arbitrary, because essentially it says we're going to take the yield to maturity on your existing debt instruments and add to that some kind of a risk premium. Again, the problem with this is that it's a subjective measurement. So if we have a bond yield of 10%, a risk premium of 4%, the 10% bond yield plus the 4% gives us a number of 14%. The risk premium that we're using is one that I don't know where we get it, but it's a subjective number. It's not going to be the same number that we used with CAPM. It's a different risk premium, and according to the textbook, it varies between 3% and 5%. It could be a rule of thumb that your company has suggested that you use. So it gives you a ballpark measure of the cost of equity, and maybe a suitable check. Now, our textbook suggests that you should perhaps consider all of the different alternatives. In this case, we just calculated for our cost of equity, a measure of 14.2% cost of equity using CAPM, 13.8% using the discounted cash flow or dividend growth model, and 14% using the yield plus a premium. On average, our cost was 14%, and they say, that's an alternative to consider the weighted average. I would suggest that you should always use the best method. CAPM is best. Academics all agree. If you can't get the measures or can't get the information for the dividend growth, for CAPM, use the dividend growth model. And, I can't imagine a situation where I couldn't solve my problem with those two tools, but if you don't have those other tools, you could just use yield plus a premium. I would never suggest taking the average, especially if you believe that two of those numbers are inferior calculations. So in this session, we've taken a look at some of the components of capital. We took a look at the cost of debt, looked at preferred shares. We looked at some of the other types of hybrid securities, including restricted shares. We talked a little bit about the calculation of the cost of equity. Now what we've done is we've figured out the way to value each of the different components of our capital. Our purpose is to figure out what the cost of capital is to our company. And it's always going to be a mix of those parts. And to do that, we use something called the weighted average cost of capital. And that's something that we're going to talk about in the next session. How do we weight the average of all of the different sources of capital in our business in order to figure out the right number for a discount rate for the calculations that we use in the value of the firm?